Joining us now is Mark Newton, Fundstrat, Global Head of Technical Strategy. After last week, it's Mark, it's good to see you. After last week, are we below certain indicators that are indicators that are signaling more selling, or is there any type of stabilization or basing pattern that you saw?
Yeah, thank you, Joe, and good morning to everybody. Look, I think it's less about the day-to-day volatility and more about the fact that we've seen a meaningful divergence between technology and the rest of the market, and that started, right around July. So tech had gone straight higher, whereas the rest of the market had largely gone sideways and not participated. So, when you look at the S&P, it's a little bit of a mirage because you see the market going straight up, but obviously that's changed in the last few weeks. We've had one of the worst Novembers now since 2008. We're down about 2%, but obviously that followed a much more resilient August, September, and October this year until the end of October. As to what's to come, my thinking is it's going to be a little choppier. It's certainly an unorthodox time for markets to be going down or sideways, but a lot of it is about lining up, the expectations of when the next Fed cut is. They say the market hates uncertainty. That's true with regards to whether or not we're going to cut or not. And I think Williams helped things out last Friday. The percentage chance of the market, cutting now was double than what it was earlier last week. So markets are, they're certainly helpful, when that kind of thing happens and start to stabilize and move higher. It's tough for me to say the lows are in per se. I think we probably could hit 6,400. But I think the maximum is probably about 7,000 now between now and the end of the year. So I'm not expecting, although I do see a bounce happening and likely starting this week, it's tough for me to say it's going to be off to the races until we start to see more evidence of more and more sectors starting to participate in this rally and not just technology.
You could have completely divergent opinions from Tom Lee, could you not?
Yeah, look, we have our own methodology, our own time frame for looking at markets.
But he expected choppiness early and then some good performance into the end of the year.
Yeah, both of us were positive this year. I rate technical analysis. Obviously, my target was 66.50. We're largely in line. We're talking with one another as we head towards the end of the year as to what next year has in store. Obviously, it's a midterm election year. Things tend to get a little choppier. Specifically, we've had two back-to-back years of over 20%. Now this year is probably also going to be 15 to 20% gains. So, it's right to have consolidation. That doesn't mean, the longer-term bull market's over. It doesn't mean we're going into a bear market or, the AI trend.
So you're at 66.50 still for the end of the year?
Yeah, I try not to change that on a week-to-week basis.
Tom's at 7,000, I think, isn't he? Or where is he?
Yeah, he was right around my level. I think he raised it a few months ago to right around 7. We got to 7. It's difficult to nitpick on levels. It's more just looking at the market as a whole, what's happening with interest rates and the dollar and equity. There's only about half of all stocks that are above their 50-day moving average with regard, and that's troublesome. That happened also this time last year, and it also happened back in 2021. And so we need to see evidence of financials starting to participate, industrials, discretionary. Obviously tech is the elephant in the room. It's important to see tech work being 30% of the market, but tech's gotten very overdone and still delivering a lot of the earnings. Earnings have been great. The economy largely has been in good shape.
So the advance has been overdone, not the sell-off. You expect more problems in tech, or does tech lead us back to?
I think tech is going to bounce after what we've seen in the last few weeks. Okay. The question is, whether some of these stocks can continue to deliver, or at least the stocks can deliver the way that we've seen in recent months. I think it's been a big run. You've seen noticeable evidence of stocks like NVIDIA slowing since July that have largely been sideways. Meanwhile, others like Apple, which are extraordinarily important for the market, 6-7% of the S&P are still doing just fine. So there's been a little bifurcation. Parts of software gave that sign earlier this summer and started to do a lot worse.
Yeah.
We need the market to be moving, many sectors moving in unison all together. We also want to have a little bit more confidence in the economy. With the shutdown, there's just a lot of, unknowns, I think, and those will, I think things will be fine heading into next year, but my thinking is, it could be a choppier time until we resolve some of these issues.